Back again, ladies and gentlemen. So look, Bitcoin's dropping down, and in today's video, I'm going to break down a couple of scenarios for anybody that's thinking, you know what, where can I put my money to minimize exposure? Because the Fed is going to be increasing the interest rates yet again, it means that investors are probably going to be turning to cash, foreign investors are going to be favoring dollar products, and of course, the Nasdaq and the S&P are making further drops to the downside. But in good news, Coinbase is now allowing retail traders in the US to trade futures. Well, people still have been able to trade futures. Volume ain't there. Let's have a conversation. So we're going to get it started with a breakdown of Bitcoin and what we can expect moving forward. I'm also going to dive into alternative ways to diversify your exposure in your portfolio. So you might have a portfolio that's got crypto, stocks, or commodities, ETFs, and I'm going to give you a couple of tips and ways of thinking that you can use to effectively hedge yourself in what could effectively become a dollar-dominated marketplace. So looking at Bitcoin right now, it has taken a little bit of a tumble. We're going into the green vector candle regions on the daily time frame, and not so long ago, word on the street was that there is a golden cross happening on the 3-day chart. Now, the problem with the golden cross is the second that it happens, people just rush to the charts and go, yeah, baby, it's happening. Bitcoin to the moon. The word to the moon, it should really be removed from the logic of trading. I'm down for it. Don't get it twisted. But it just kind of takes you away from what we need to really focus on. You know, we're dealing with money here, ladies and gentlemen. I don't know any institutional fund managers or hedge funds shouting to the moon. They actually probably say something else. Probably not so polite. Something that I would love to say on a video like this. Get that mother, you know, and this thing better. You know, those sort of things. But Bitcoin to the moon, it's an idea. It's an emotion. It's hope. We ain't got time for hope in the market. You can't be coming to the market with hopefulness. We can only work with logic and probabilities. The way we can exploit probabilities and logic for profit is if we understand the nature of how things operate. The 3-day chart shows the golden cross. Does that mean you just buy? Well, if you brought on the logic of the 3-day chart showing the cross of the 50 EMA over the 200 EMA, logic would say that you're experiencing a little bit of a pain right now. Because if we actually go back with the chart and then say, okay, let's just go over to the moment that the 50 crossed over towards the 200 EMA. This is what we saw right here. Look at that. Oh my days. Retail. Oh my God. 3-day chart is showing the crossover. That's it. I'm going long. Because I don't know what's going to happen next. But the 3-day chart shows the golden cross. Let's go long. Okay, so you went long on your golden cross. Saw a little bit of success. Now from your long up here around 29 zone, now Bitcoin's at 28,592. The golden cross has actually evolved. You look at it and that's on the 3-day chart. You go over to the 4-hour chart. Bitcoin's done nothing but just drop down since the golden cross has happened. You sat there thinking, hold on a second. Oh, I need to know if this 3-day golden cross is going to keep on working or not, man, because it's starting to hurt me. For some, it might not. But for others, it might. Look at the actual chart now. The 3-day golden cross, whatever it is, has happened. So logic says that we want to see the expansion happen. But look at where we are financially in the marketplace. This is the issue we've got. The marketplace right now is showing that the dollar dominance is coming into action. Now, as long as Bitcoin, or should I say dollar, keeps on going up, Bitcoin's going to have a hard time moving higher. Dollar is trending upwards. You only need to go and check out dollar yen. Look at this madman right here. Dollar yen is just going for it, and it keeps on trending higher. And it's probably going to keep on going, because what's happening now is higher interest rates, and the potential for more interest rate increases is only going to encourage foreign investors to step in and start picking up dollar-based products. So assets like USD CAD, they're going to be going higher. Look at that, trending upwards, okay? Go into the dollar dominance. Now remember, dollar dominance can also mean that investors are seeking cash. So the guys already in the US that are experiencing the pain of higher interest rates are probably going to be selling their products going into cash-based situations. So that's why the dollar is going up, because everyone's transacting off the back of the dollar. They're selling their euros. Look at euro. Euro's been taking a tumble to the downside. So that means people are getting rid of their euros and effectively putting it into dollar. Look what's going on. It's trending lower. Now, with that being said, look at the yields. The yields are up. That's not a good sign. The bonds are down. We always look at this chart because it gives us the heads up of where the reality of traders' mindsets are at, or hedge funds, banks. What are they doing with the money? If they're not giving it into the bonds, that means the government has to advertise higher interest rates to encourage native users of the dollar. So companies in the US to give money to the US government. The foreign investors are already here because the interest rates are high. And now they're going to have another increase. Yo, man, the foreign investors are going to come and plant their money in the US, which is going to inflate the value of the dollar, which means assets like euro, pound, gold are going to go down and dollar's going to go up. That means Bitcoin could be going down even more. So how can we diversify ourselves? Well, look, Goldman Sachs, it's a bank. That means it offers financial products. Now, those financial products are going to come with charges. They're going to be reflecting the actual interest rate. So if interest rates right now are 5.25%, 5.5%, that means any financial products that they offer where they're giving money to a company, consumer, you name it, they're going to add a little bit more interest on top so that they can cover their base. Now, high interest rates means that people have to spend more money on any loans or mortgages that they may obtain from any bank. That is only going to benefit Goldman Sachs, JP Morgan, Barclays, HSBC, Bank of America. They're going to see the benefit. So during times of high interest rates, investing in banks could be a good option. Not for you to make money, but for you to diversify exposure. Why? Because look at Goldman Sachs. It's been trading sideways. Now, you don't want price to go up. You don't want price to go down, but you want it to be at a level where you can effectively put liquidity so that you can cover yourselves from exposures. Like, look at Bitcoin. Bitcoin has been dropping. So anyone that's got their whole portfolio in cryptocurrency, it's now dropping in value because everything is relying on cryptocurrency in that portfolio. Most institutional fund managers split their investments by 40% bonds and 60% stocks. So right now there's going to be a change in how investors or institutional fund managers are managing their portfolios. They might even go over to ETFs. Check this out. You've got an ETF like this, the Paris Aligned Climate one, which is made up of a lot of stocks based on the Paris Aligned Climate. Now, if we go into the actual holdings of this ETF, which an ETF is an exchange traded fund, which allows you to effectively invest in a number of stocks, okay? And you kind of minimize exposure because it's made up of the movements of what's going on inside of all these stocks. A group of these stocks might be favoring higher prices and they end up moving higher. And some of these stocks might actually go lower, and it effectively minimizes your exposure to lots of volatility. Don't get it twisted. This ETF has actually done pretty well year to date, given that it's now up 15%. Only a few days ago, it was actually up 20%. So it's actually taking a little bit of a drawback, okay? But not that much. So that's one way that you can effectively diversify yourself. Now, the issue that we do have is with high interest rates, the tech market is prone to this. Now, we've got to be very careful if we get involved in specific ETFs that are predominantly tech-based. Here's an example. If you go over to NVIDIA, and NVIDIA, we know there's a lot happening with Nvidia right now. We've got the big earnings announcement that's going to come out, which is pretty much going to be the make or break for AI. Now, if you get into an ETF that has Apple, Microsoft, Nvidia, Meta, Tesla, it has lots of companies in that are cash rich. But as a tech company, they are prone to high interest rates. What you're looking for is you're looking to invest in companies that have high cash, not so much debt. Nvidia has 44% debt, if you can see over here. 44% debt. That means when corporate refinance comes into play at the new rates that the Fed gives, that means Nvidia is going to have to pay back quite a bit of money to debt that they have. Now, that debt could be with Goldman Sachs, JP Morgan, any loans that they may have taken on for certain ventures inside of the business. They have to repay that. That's only going to come out of the pocket of the shareholders. You go into the likes of a company like Amazon, and then we say to ourselves, okay, what's Amazon's debt like? 96%. Oh, gosh. Household name. Bad boy market cap, nearly $2 trillion. And it's got 96% debt. Is that really a good shout? If interest rates are going up, these guys are going to take a little bit of a beating. We go into companies like Meta and we ask ourselves, okay, what's that story like? What's their debt like? We look at Meta and you can see it's actually 8% debt. So these guys ain't going to be prone to high interest rates. That's a good sign. So now you're saying to yourself, okay, then if I'm going to get involved in diversifying my portfolio with banks and tech stocks, I want to get involved with banks that are effectively offering products that they can receive an income off based on higher interest rates. So effectively, the truth is they're squeezing the consumer off the product and the business. I want to get involved in tech stocks that aren't going to have a problem with high interest rates if their debt is low, like Meta. Look at Tesla. You only just need to look over there. What's Tesla's debt like? Coming up right now, 4%. So hold on. I'm going to be paying attention to Tesla because it's effectively saying to us that they only have 4% debt. Meta, 8% debt. That means there's a lot of cash in their pockets. So worst case scenario, this company isn't going to fold. Now, I'm not saying that Amazon could fold, given that it has 96% debt. But what I'm saying is it's going to be prone to high interest rates. And that might end up being, there could be a lot of changes inside of the business so that they can alleviate the pressure of higher interest rates. Now, the Fed doesn't want to squeeze the market too much by increasing the interest rates so aggressively where it effectively hurts Amazon, given that it has a $2 trillion market cap and it's just recently dropped from 3. So that kind of puts things into perspective for us. So when you're coming to make a decision about where you should put your money, it's not financial advice. I'm just telling you that there are other ways that you can effectively diversify your portfolio. If you're predominantly cryptocurrency based, then you don't want to exchange your capital into fiat. I guess you're going to have to ride this one out. But if you have a split in your portfolio where you do have cryptocurrency, you do have stocks, based on the way things are economically, high interest rates are going to be beneficial for banks. They're also going to be beneficial for companies that don't have high debt, like Tesla, like Meta, okay? Those are the companies that are going to be able to withstand these trying times, especially when interest rates are going to be increased even more. Looking into ETFs could be a good option. So if you do look at ETFs, make sure you're focusing on the bigger market cap stocks that make up the ETF and focus on the debt of that company. Because the higher the debt, the more prone to volatility that company could be subject to. Because if that company says, yeah, we need to lay off our employees, or we need to stop providing this product, or we're closing down one of our enterprises, When they start talking like that, that means they're trying to release capital, free up cash so they can service any of their liabilities. That's a warning sign, and that can lead to sell-offs by shareholders. So keep that in mind, ladies and gentlemen. Today we have the unemployment claims coming out at 1:30 UK time, 8:30 a.m. Eastern Standard. This is going to be the deciding factor, in my opinion, to seal the nail in the coffin, because if the labor market is still strong, the Fed is just going to keep increasing interest rates till they get to 2%. And Bitcoin might have a bit of a problem with that. Mad love and respect, ladies and gentlemen, and I'll be checking in with you tomorrow. Peace.